Welcome to F5 Performance Management. In this section, I will go over management reports. What are management reports? They are internally produced reports detailing important company information, such as the profit and loss or the costs, etc. They can cover any period of time, but are usually over 1 or 4 month period, depending on the company. These reports are used for internal decision-making. Management reports should be communicated through the appropriate channels. So, for example, don't make a report out of what can be sent quickly and effectively in an email. Management reports also contain good quality information. These reports must be easy to use. If it's not easy to use, management may not bother looking at it. The report must be understood and be relevant to its users. The report must be complete. A half-finished report is not much use. The value of the information in the report must be more than the cost it took to produce. Be this the time cost or the resources invested in it. The report must be given in adequate time to enable decision makers time to review the report and to make their decision. There must be controls over the production of management reports. If not, time and money could be wasted and sensitive information could be leaked. Before a report is done, a cost-benefit analysis should be done. Do the benefits of having this information outweigh the costs of putting this report together? The formatting of all the organization's reports should be standardized and be consistent. This saves time you could have spent deciding on fonts and whatnot. It also ensures consistency so that the report is less likely to be misinterpreted. The user's requirements must be clear and understood. If they are not, the report writing team must verify them before the report is started. When the report is finished, they should be checked again against the report. The report should clearly outline its recommendations and actions that need to be taken by management. A report full of information is all well and good, but not much use if it doesn't give me a few indications of what I should do based upon its findings. The writers should be clearly identified. Transparency and accountability will result in more accurate information. If a company writes a report, this means it's using its valuable resources, its staff time, to do that instead of something else that could be bringing in company revenue. Therefore, reports should only be written if they are going to give new information. Sensitive information. The information contained in managers' reports is often confidential to both users external and internal to the organization. For example, management would not want reports detailing new product designs being accessed by competitors so they could be copied. Similarly, management may not want staff to know of staffing issues or restructuring plans so as not to cause panic. What controls can be put in place for sensitive information and to protect it? Information should only be given to the relevant parties and nobody else. Employees should sign confidentiality agreements, preventing them from sharing sensitive information with third parties. Secure all computer files with a secret password, not one that everybody knows, and that password should be kept securely and not in a post-it on your desk. Hold all sensitive reports in a safe place that can be locked, like a small room. The company's information systems should be protected with firewalls from people getting in from the outside. As well as firewalls, encryption should be used to code files so they cannot be read by hackers. Antivirus and anti-spyware software should be installed to protect the company and its information. Under Personal Data Protection Acts, companies must protect personal data and not give it to third parties. Therefore, personal data must be kept confidential. Welcome to F5 Performance Management. In this section, I will go over sources of management information. Companies need good quality information to make decisions. Management accounting information is for internal use, for managers and other decision makers to make decisions with. Management accounting gives much more up-to-date information than the annual financial accounts, which are prepared once a year. That is why it is so important to decision making that the information is time sensitive. The internal sources of this information are the company's accounting records, so the books of prime entry such as the sales daybook, purchases daybook and cash book. Management can find financial information such as the amount of cash versus credit sales during, say, the last month or week, or the profit earned on certain products. Payroll records, so the wages costs and the quantity of people and time required to do a task or make a product. Departmental records of incidents, say accidents. Information received from customers, so for example customer comment cards or complaints. But these records give management more than financial information. They give non-financial information too, like quantities sold and their combinations. Did you hear about the supermarket that from looking at its customer spending patterns that a popular combination sold was babies' diapers and beer together? They learnt this by looking over the sales registers, the books of prime entry. What did they do with this information? The supermarket then located the baby's diapers close to the beer aisle, resulting in much more sales of both products. If you came in to the supermarket looking for beer, seeing the diapers, you may decide to buy some just in case your baby runs out. So the power of the management information. The company does not operate in a vacuum, and the management must look at information outside the organisation for decision making too. Sources of external information are the government. They provide publications on new legislation, taxation policies, etc. The media. The media gives information about changes in the organisation's industry or technological changes, etc. Financial institutions, giving information on, say, potential customers and foreign currencies. Competitors' financial statements. The Internet and public databases. Keeping on top of new information from these sources will help the company make better decisions. Management information, as well as being important for decision making, is a powerful control tool. Both internal and external sources are used. This information is compared to either the budgeted or forecasted results to find the variance and the reasons for the variance. Internal information such as cost reports can be monitored to measure the variances from the budgeted or forecasted results. External information is used to benchmark the company against their competitors. The control process using internal and external information is as follows. Management review the previous month's sales volumes. This is internal information. And they decided to gain 3% more of the market share. Market share information was gotten from external sources. The management now decide how this goal is to be achieved. The next month's sales figures are examined to see if the target has been achieved. This is called feedback. This is internal information. The feedback demonstrates if the company is on target for achieving its goals. Depending on the results, management will go back and amend their original controls to improve on results. This is sometimes called the feedback loop. Management information is a powerful tool, and good decision-making will result in more profits for the company. But management information does not come free. The main costs associated with it are direct data capture costs, processing costs, indirect costs. Direct data capture is a data input where there is no data entry. What does this mean? Data from nothing? Not exactly. You are probably very familiar with buying goods in a shop. Here, you go to the cashier with your goods, which are then scanned. The barcodes tell the shop's information systems what you have bought, calculating your bill. The data is inputted into the computer through the barcode reader. It has replaced the cashier typing in everything you have bought. So, direct data capture is great. It saves time. You don't need to worry about spending half an hour at the till while the cashier writes out and totals your bill. But there are costs associated with it. Obviously, there is the initial setup costs and then the linking costs. But being able to read the product codes and total a bill is awesome. But what if it could also be used to update inventory levels, etc.? So link this information throughout the company. This linking cost will also be a cost. The main cost here is the setup of the systems and their maintenance and updating them to keep them up to date with current technology. The data that they collect must also be saved or stored somewhere, so there are storage costs. Processing costs come from processing and analysing the information. This is mainly staff hours. So back to our cashier. The information entered into the till is valuable, but it is only valuable when it is analysed. So someone is employed, like an accountant, like yourself, to analyse and spot trends in the data. The supermarket always had the data that it was selling beer and diapers together, but the information had to be analysed to find this trend. This is very time-consuming, but it is very important for the company's long-term growth. And finally, we have the indirect costs of producing information. Information overload creates a lot of indirect costs by either staff getting so lost in the detail and spending too much time on analysing information, wasting time. Poor decisions which cost the company can be made from overload of information. Some famous political leaders insisted that information briefs were no longer than 1 page, giving them the essential information and not overloading them so they could think clearly about the issue. Past data is always being analysed. It is possible that the company becomes so focused on the past that it fails to look to the future, for example, technology and legal changes. These days, external information is obtained through the internet. The internal costs of enabling staff access to the internet is time wasted on non-business activities, security risks from outside the companies through malware that is either accidentally or purposely downloaded by staff. The limitations of using externally generated information. Quality. Information produced externally may not be accurate or reliable. Steps can be taken to reduce this risk. For example, only using reputable sources. But these may be out of date, affecting the accuracy of the information. Information needs of the organization may not be met because this external information was not created for this company's purpose. Difficulties in sourcing. It may be very difficult in sourcing the external information. For example, detailed breakdowns of competitors' sales will be very difficult to get because companies tend to keep this information confidential. External information is very important for decision making, but its limitations must be remembered to minimize them.
This session will cover management information systems and reports. Management accounting and information systems are an integral part in producing the information that managers use for performance measurement and performance management. Performance management information systems will provide the information which enables performance measurement to take place. The type of management information system needed will depend on the level of data needed to support the company's decisions to be made. Planning, control and decision making can be classified into a three-tier hierarchy known as strategic, tactical and operational. So let's look at each in turn. Firstly, strategic. Strategic planning is the process of deciding on the longer-term objectives of the business and the high-level policies surrounding them. For example, new ventures, new products, potential future growth, or maybe capacity expansion plans. Management accounting information needed to support those strategic plans will be forward-looking, usually for several years, and will have an external orientation. It could also be vague, including estimates, or there could be elements of incomplete data. Examples would be product profitability, financial effects of competitor responses, or maybe the effects of acquisitions and mergers. Secondly, tactical. Tactical planning is the level below strategic planning and focuses on the most efficient and effective use of resource to support and achieve the long-term strategic plans. For example, this could include decisions around the level of resource required, money, manpower or materials, etc. It will also include decisions around the processes needed to achieve the maximum output from the level of resource used. Management accounting information needed to support tactical planning decisions will have a much shorter time horizon in comparison to strategic planning data. There will also be much more precision with a much narrower focus on information. Most of the information will be generated from within the organisation. Examples would include annual budgets for sales and production, the levels of inventory to be held, or maybe marketing and advertising campaigns. Lastly, operational. Operational decisions are the lowest tier in the hierarchy and focus on the day-to-day specific tasks, ensuring there is maximum efficiency and effectiveness. And just as tactical planning decisions are made to support strategic planning decisions, operational decisions will be set within the guidelines of tactical decisions and control. Management accounting information here will be very detailed, have a very narrow focus and a very short time frame. Examples would include day-to-day transaction data, current inventory levels, or scheduling unexpected or ad hoc work. Operational data is more often expressed in number of units, hours, or maybe material quantities, as opposed to monetary terms. Finally, it is important to recognise the link between the tiers on the hierarchy. For example, the board of directors of a company may decide to launch a new market with the aim of, say, taking 5% of the total market within 3 years. This would be a strategic decision. Senior management would then be required to plan the necessary resource to support this, e.g. man-hours, equipment, advertising, sales promotion, etc. These would be tactical decisions. And then finally, lower management may set weekly targets for production and sales staff, ensuring quality of product and timely delivery to customers. In terms of the types of management information systems, there are several types that can provide data to an organisation. The first one to look at is called a transaction processing system, or abbreviated to TPS. A TPS system has the ability to collect, store and modify and retrieve large volumes of data of an organisation. And the key characteristics of a TPS system are as follows. Basically, rapid response. If fast performance is vital to a business, the input needs to become the output in a matter of seconds. Reliability. Some organisations rely heavily on a TPS system. If potential failure could stop business, then a backup and recovery process must be in place. Inflexibility. A TPS system will follow a standard process route. It is not able to adapt or have any flexible response to any input it will receive. And finally, processing. A TPS can process data in batches or in real time. With batch processing, data is collected throughout a designated time period and processed at a later point in time, giving a time delay. However, real-time processing is the immediate processing of data. This would be vital for organisations that deal with things such as flight, train or hotel bookings, which need an immediate response. The next system is just known as the Management Information System, abbreviated to MIS. A Management Information System has the ability to take data from the TPS system and convert it into summary or exception reports for decision making. For example, some management information systems allow users to generate customised reports. For example, this may break down sales into product type, region, salesperson, etc. And most have different display choices, e.g. graphical or tabular. It is important to note that a management information system generally doesn't have any analytical capability. The next system worthy of note is called an Executive Information System, or abbreviated to an EIS. This system will typically draw critical strategic information data from an internal management information system, and then will also allow communication with external sources of information. For example, data from competitors, maybe legislation, market research, and maybe databases such as Reuters. An executive information system will typically involve data analysis and modelling tools, and it is capable of performing what-if analysis to aid strategic decision making. The last system is an Enterprise Resource Planning System, or abbreviated to ERP, an ERP. An ERP system is designed in a modular way and will allow integration between the key processes of an organisation. It has the capability of serving the data needs of all the different functional departments. Typically, an ERP system will support sales and order processing, probably procurement, production, distribution, customer service, human resource and finance activities. The principal benefit of an ERP system is that it shares the same data between different departments. For example, if a customer order is entered into the system, it will check current inventory levels and prompt purchases if necessary. It will update the manufacturing schedule and deploy adequate resource at the time of manufacture. The system will update any shipping or distribution schedules and will trigger an invoice to the customer at the appropriate time. There are many benefits to be realised from a fully integrated ERP system, including the removal of inefficiencies and duplicated data with significant savings on time and effort. In addition, many ERP systems will have electronic data interchange facilities with major suppliers and customers for the automated transmission of documents such as purchase orders and invoices. A system, i.e. something that connects things up, can be either open or closed. A closed system is isolated from the external environment and data will not be provided to or received from the environment. Closed systems are very rarely found in naturally occurring situations, and certainly within a business environment there is a real need to communicate and react to the external environment just in order to survive. As such, business organisations are open systems. The decisions they make will be influenced by suppliers, customers, maybe government or financial institutions. By having an open system, a business can focus on the external factors that are critical to the success of the organisation and adapt to the changing environment as necessary. Next, we will consider the sources of management accounting information, and these sources can be both internal and external. Starting with internal source, this will include data captured within the financial accounting records, such as data from the sales and purchase ledgers or maybe payroll data. It is important to understand that not all data will be monetary. Production data may include machine capacities, movement in inventory levels, maybe maintenance requirements or sales data. It may include the number of returns or product warranty issues. A significant amount of this data will be extracted from the company systems, but there could also be informal communications between management and staff, interviews or maybe documented meetings. External information generally tends to be more relevant to strategic and tactical decision making as opposed to operational decision making. There are many external sources. For example, a company may employ a legal expert or tax specialist who will collect information regarding their specific area and understand how this will affect the organisation and pass the information on to those who are affected. A marketing manager may commission some market research on a potential new product, and organisations will hold data from their own customers and suppliers due to the interaction they have with them. Data can be obtained through internet or trade journals. External data can be either primary or secondary. Primary data is tailored to a company's exact needs. Market research commissioned by a company would be a good example of this. The advantage of primary data is it will be meaningful and 100% relevant to the company. However, the biggest disadvantage is that generally it will be more expensive than secondary data to obtain. Secondary data is not collected by the organisation itself. Examples will be government statistics, internet or public databases, or maybe data from trade journals or consumer panels. Secondary data can be very valuable to a business, and both time and money will be saved in comparison to primary data. However, the disadvantage is that the data may not be totally relevant to the organisation. In addition, the data may be biased, dependent on who originally carried it out or for what purpose. Organisations using secondary data should ensure that they only use meaningful data. The costs of obtaining and using information, both internal and external, can be significant. With regard to internal data, the costs of collection, processing and the production of data can be divided into three categories, these being data capture costs, process costs and other indirect costs of producing the information in the required format. Examples of these could potentially include the costs of barcoding and scanning equipment, time for personnel to input data into a system, or maybe time spent analysing the data and producing it in a usable format. Companies should be mindful of the cost of inefficient use of information, for example collecting data that is not needed or not used, or possibly the duplication of information. With regard to external data costs, these could include the direct costs of a market research survey, maybe subscriptions to journals or magazines, and maybe the cost of internet downloads. These types of costs are easily identifiable and can be considerable. There will, however, also be indirect costs associated with external data, such as wasted time for excessive searching, processing and general information overload, the costs for which are much more difficult to identify and quantify. Once the relevant data has been collated and processed, it is important to consider the necessary controls over such information. For example, internal data may well include sensitive and confidential data, for example personnel or payroll records, which should only be made available to certain individuals within an organisation. Typically, organisations may well have a procedures manual which sets out the controls for distributing internal data. This could include the format of the report, the frequency of them, who should be included on the distribution list. It will make clear as to what information is regarded as confidential and whether any paper documents could be binned or require shredding. In addition, it would be normal for employees to be contractually required not to divulge any confidential information that they are privy to. Much data now is distributed throughout an organisation via emails, and it is important that organisations adequately consider computer security. With regard to internal security, management can regulate which members of staff have access to different types of data. For example, access to human resource records will be restricted to human resource personnel. Passwords can limit access to certain areas within a system and will also provide an audit trail to establish any unauthorised attempted access. Information transmitted from one part of an organisation to another could be vulnerable to interception, so it is important for companies to establish a policy for encrypting confidential data. Encryption is a method of scrambling data so it becomes unintelligible to any unauthorised party who attempts to intercept it. The growth of the Internet has led to a much greater increased exposure to security risks. An organisation can protect its data from external unauthorised access by using a firewall. A firewall will selectively allow or block inbound traffic to an organisation's computer system by blocking any messages that do not conform to a specified set of criteria. They prevent unauthorised internet users from accessing private networks. In addition, computer viruses may arrive by email, which can be triggered when the user opens the email. Computer viruses can infiltrate and damage computer systems, while other spyware viruses watch activity on a computer system and then send the data over the internet to a third party. Antivirus software will scan files looking for known viruses and identify suspicious behaviour from a computer program that could indicate infection. Physical controls to data within a business could include door or cupboard locks or safes to prevent access to hardware or paper documentation.
Hello, in this video we will be considering big data, what it is, and the opportunities and threats the organisation faces due to big data. As a related topic, we'll also consider data analytics, processing data to gain insight that help inform and implement organisational strategy. Let's start off by defining big data. In the modern age we are drowning in data. It is all over the place in a variety of different sources. Consider for a moment your digital footprint. You may post what you're up to today on Facebook or a photo on Instagram, saying where you are, what you're doing, who you're with, the clothes you're wearing. You may also have searched online for something to buy or downloaded a book. You may have listened to some music on Spotify. You may even have spoken to appliances in your home to turn the heating on. This is in addition to all the loyalty cards you use telling vendors what your big shopping habits are. All of these things leave a trail. Big data is information such as this, scattered around the internet. What use could this be to an organization? Before looking into potential use of big data, let's review what are its main sources. In theory, they can be grouped under the headings of social, human, machine, sensor, and transactional. Social or human is a source that's becoming more and more relevant to organizations. This source includes all social media posts, video postings, etc. Machine or sensor data comes from what can be measured by the equipment used. And transactional comes from the transactions which are undertaken by the organization. This is perhaps the most traditional of the sources. A core area of theory about big data is Laney's 5 V's. The 5 V's help us to understand simultaneously both the advantages and the disadvantages of big data to a business. Let's work with an example as we go through the list. Imagine a business is attempting to build an accurate profile of its customers to help it plan its product range into the future. The first of the 5 V's is volume. There is an awful lot of this data out there. This is an opportunity because there is plenty to find out. A detailed picture could be built up of our customers to help us plan successfully for our new product range. However, there is also an issue. With so much data and information out there, it's difficult to cope with it all. We need to process all that data, and that takes time and money. We need to be smart in the way we approach this. The second of our 5 V's is velocity. It changes constantly. You may have posted somewhere in the last hour where you are or what you are doing. This is a great opportunity to build a remarkably current picture of you. Regular updating means we can understand what you are like now, as well as what you were like. Trends can be mapped as a result. We might see, for example, you are planning to go on a walking holiday this year, and that, through analysing Facebook trends, lots of your demographic are taking this up as a new hobby. This could help inform our choices for our product range. However, the fact that it keeps changing so quickly is also a challenge for us. Keeping pace is difficult, and the pictures we pull together of you will be very quickly out of date. Our ability to utilise current information quickly is important. The third of the 5 V's is variety. The information is an awful lot of different sources and in different formats. Photographs, social media postings, website cookies, GPS tracker information, emails, instant messages, and so on and so on. This is good in the sense that information is a rich palette. We can build up a complex multi-dimensional hologram of you to help us plan more accurately. However, practically, it's also a problem. Trying to name and access the sources and summarize the data meaningfully is a huge challenge. Because not all of the data is readily usable in analytics, it is important to differentiate between the 3 types of data. Structured data is the easiest to work with. It is highly organized with dimensions defined by set parameters. Think spreadsheets. Every piece of information is grouped into rows and columns. Specific elements defined by certain variables are easily discoverable. It's all your quantitative data. For example, age, billing, expenses, credit card numbers, etc. Structured data follows schemas, essentially roadmaps to specific data points. These schemas outline where each datum is and what it means. It is the easiest type of data to analyze because it requires little to no preparation before processing. A user might need to cleanse data and pare it down to only the relevant points, but it won't need to be interpreted or converted too deeply before a true inquiry can be performed. Unstructured data is all our unorganized data. You might be able to figure out why it constitutes so much of the modern data library. Almost everything you do with your computer generates unstructured data. No one is transcribing their phone calls or assigning semantic tags to every tweet they send. While structured data saves time in an analytical process, taking the time and effort to give unstructured data some level of readability is cumbersome. The hardest part of analyzing unstructured data is teaching an application to understand the information it's extracting. More often than not, this means translating it into some form of structured data. Almost universally, it involves a complex algorithm blending the processes of scanning, interpreting, and contextualizing functions. Semi-structured data toes the line between structured and unstructured. Most of the time, this translates to unstructured data with metadata attached to it. Let's say you take a picture of your cat from your phone. It automatically logs the time the picture was taken, the GPS data at the time of the capture, and your device ID. If you're using any kind of web service for storage, like iCloud, your account info becomes attached to the file. Semi-structured data has no set schema. This can be both a benefit and a challenge. It can be more difficult to work with because effort must be put in to tell the application what each data point means. The second classification of data is based on its measurement levels. In this respect, there is a difference between categorical and numerical data. Categorical data describes the categories or groups. One example is car brands like Mercedes, BMW, and Audi. They show different categories. Numerical data, on the other hand, as its name suggests, represents numbers. It is further divided into two subsets, discrete and continuous. Discrete data can usually be counted in a finite matter. A good example would be the number of children that you want to have. Continuous data is infinite and impossible to count. For instance, your weight can take on every value in some range. The fourth of the 5 V's is veracity. It means accuracy and truthfulness and relates to the quality of the data. If we want any analysis to provide useful findings for decision making, the data collected must be true. But how is this done in practice? To assess how true the data collected is, companies must consider not only how accurate or reliable a data set might be, but also how trusted is the source of the data. They must be able to trust the source of the data being collected and be confident that the data is reliable and accurate if they are to base important and often costly decisions on the findings of its analysis. The difficulty that companies face here is that by its very nature, the data collected comes from many different sources. Take, for example, data from social media. They can be easily manipulated, particularly given the recent increase in so-called fake news and growing reports of deliberately manipulated customer reviews on retail sites. The final of the 5 V's is value. There is little point in going to the effort and expense of gathering and analyzing the data if it does not ultimately result in adding value to the company. This is why it is important for companies to consider the potential of big data analytics and the value it could create if gathered, analyzed, and used wisely. In fact, each of the 5 V's is a huge challenge. However, the prizes are potentially huge. It can be a source of competitive advantage. If we can understand our customers better than others, we stand a good chance of making better decisions as a business. The challenges can seem overwhelming, but remember this, no one said this needs to be mastered perfectly, as indeed it cannot be mastered perfectly. You just need to do a better job at it than your competitors. Another concept related to this topic is the big data or DIKW pyramid. It is also known as the knowledge pyramid and explains the relationship between data, information, knowledge, and wisdom. A range of raw data could be collected from various sources. For example, a company collects a range of data from previous purchases, customer questionnaires, or social media posts. The raw data can be analyzed to look for trends or patterns. For example, it may appear there is a link between the purchase of a particular product and a particular group of customers. This is information. In the next step, the company analyzes information further to establish how the identified links are connected. Knowing the details of exactly what types of customers buy a particular product or favor particular products, features is knowledge. Finally, the knowledge gathered can be used to make informed business decisions, and this is wisdom. For example, a company could adapt the packaging of its products to the tastes of different customer groups. Big data raises difficult ethical questions. Some people have a Big Brother style concern about businesses building detailed profiles of us, as well as potentially about legal concerns relating to data protection. Both of these risks carry associated reputation risks if our use of big data becomes public knowledge and it isn't received well. Also, increasing linkages with external data sources increases the risk of viruses infecting our systems. So big data is not without its risks and problems, but it has a huge upside potential. Data analytics is concerned with processing data to gain new insights that hopefully can be used to inform decisions in the organization. It may inform decisions to what we make, how we sell it, and who we sell it to, for example. This is not a new idea. Even before the days of big data, organizations were exploiting their internal data resources by consolidating them into one place, known as a data warehouse, and analyzing it to their advantage. One such example of an analytical procedure is data mining. A data mine is a piece of software that burrows into a set of data and notes apparent relationships between data items, and tells you what it's found. A finding may or may not be useful. For example, it may say when sales increase, costs tend to increase, or when sales increase, profits tend to increase. Well, you may well have known this anyway. However, on occasion, it may just tell you something you didn't know, and that you can exploit to your advantage. Another thing to mention is predictive analysis. This is a type of data mining which aims to predict future events. For example, the chance of someone being persuaded to upgrade the flight. When analyzing data, it is possible to use both descriptive and inferential statistics in our analysis. Descriptive statistics is the term given to the analysis of data that helps describe, show, or summarize data in a meaningful way, such that, for example, patterns might emerge from the data. It does not, however, allow us to make conclusions beyond the data we have analyzed, or reach conclusions regarding any hypothesis we might have made. They are simply a way to describe our data. For example, if we had the results of 100 pieces of students' coursework, we may be interested in the overall performance of those students. We would also be interested in the distribution or spread of the marks. Descriptive statistics allow us to do this by using a combination of tabulated description, such as tables, graphical description, such as graphs and charts, and statistical commentary, such as a discussion of the results. Inferential statistics are techniques that allow us to use these samples to make generalizations about the populations from which the samples were drawn. It is therefore important that the sample accurately represents the population. The process of achieving this is called sampling inferential statistics, and arises out of the fact that sampling naturally incurs sampling error, and thus a sample is not expected to be perfectly representative of the population. In conclusion, as we've discussed, businesses create an advantage through exploiting core competencies and unique resources. Big data and how it is analyzed can help improve the quality of decisions made in the organization, enhancing the value added by the business. The organizational processes related to big data, therefore, in themselves become a dimension of competition. If we can deal with it better than our competitors, we will gain an advantage over them as a result. Thanks for listening.